Well, greetings, my beloved clients and friends. So today is March 7th, and I got an email from a client, and he had a question, and I was wondering if he has that question, maybe others do as well. So I wanted to address it, and it was in regards to a recent addition to the portfolio, and this company that we bought was not highly regarded by analysts on Wall Street. And his question was, well, what didn't you see what the analysts are saying? Why would you buy a company that doesn't seem to have very good ratings? Okay, so I want to talk about Wall Street Analysts for a little bit. And there's a few that are very good. There's a handful of analysts that are excellent. But as a group, the vast majority of analysts tend to be followers. Okay? Analyst recommendations tend to follow a stock. They don't tend to lead it. And you'll see, stock price going up, analysts start raising their expectations, following the price of the stock. Stock price starts going down, analysts start lowering their recommendations, following the price of a stock. They're not leading, and they're following. Okay, and as a group, that's what they tend to be, kind of like lemmings. Okay. I've been to conferences with analysts, and I see the group, and they all dress the same haircut, same watch, same hobbies, same Patagonia vest. They have that herd mentality and a follower mentality, and they're not looking to stand out or say something different than what the group is saying. They tend to parrot what's being said at the time on Wall Street, the vast majority. Okay, and so what if I followed the recommendations of the majority of the analysts? Meaning, after they all figured out something, then I said, okay, now I'll jump on as well at the tail end, right? If once they've all figured it out, it's probably already been priced up, and the last guy, you don't want to be the last guy to acknowledge that this company is good. You know what I mean? That's probably when it's riskiest, when it has all the recommendations from the analysts. Because how's it going to go up any higher? They've already given their stamp of approval to it. What's going to take it higher, right? If all the analysts of a company have a buy rating on it, where's the upside potential? There's way more downside potential for disappointment than any upside. So as a matter of fact, if we see a company that has recently had a lot of downgrades, that perks our ears. That's like, maybe this thing has been beaten up because they've been chasing this thing down, and then they finally acquiesced. It's called capitulation, right? The last analyst finally took his buy rating off of it. That's probably a good time to buy it. Okay. So I just want to get that picture that the best investments I have made have been when no analysts are the ones that no analysts recommended, that I didn't get the idea from a bunch of analysts that are already touting it. To the contrary, I did it in the face of analysts saying the opposite. As a group, as a herd, right? Tesla is the perfect example. When I bought Tesla, it was not highly regarded on Wall Street or highly recommended by analysts. It was actually highly shorted, and it was actually, the herd of analysts it was a laughing stock among them that that, oh man, this thing's going to go bankrupt. All they do is burn cash. So, and that's when the stock is the cheapest, right? When there's most potential for it, when you're the first one to see it, and then slowly a few analysts kind of open their eyes, and it's not the nature of an analyst to be the first to recommend something. Like I said, they have a herd mentality, so they're not going to do it. They're just going to parrot what they already hear. But that one vanguard analyst that finally comes on board, and then as the other ones come on board, the stock goes up. But you don't want to be the last analyst on a company to finally see the light, right? GameStop was another one, right? That was a huge win in a very short period of time. And it wasn't because a bunch of analysts were jumping on top of this company touting how great it was. And it was the consensus that, oh yeah, GameStop is great. Look at all these analyst recommendations in favor of it. It was quite literally the opposite. That one was as extreme, if not more extreme, than Tesla as far as the negative consensus on Wall Street around this company. But they don't take the time to do original research. They just parrot what they hear, right? And I didn't really have to dig that deep. I just had to think for myself, and which is something analysts do not do. I'm going to tell you, Benjamin Graham, in his book, The Intelligent Investor, he wrote 5 characteristics of an intelligent investor. Here they are: patience, discipline, eager to learn, harness your emotions, and think for yourself. By their nature, analysts don't have those characteristics. Okay? And then you put them on Wall Street in a group of other analysts, and it's very difficult for them to be patient because they got to do what everybody else is doing. It's very difficult for them to be disciplined because of the peer pressure to follow the crowd. Okay? It's very difficult for them to be eager to learn on Wall Street. They don't have to search out knowledge. Knowledge is falling into their lap. And you have to ask yourself, if knowledge is falling into your lap, how did it get there? Was there maybe an ulterior motive, rather than you going out and searching in the library for the knowledge that you're wanting to acquire, right? And so they don't have to be eager to learn. Harness your emotions. Wall Street is a very emotional place, right? And there's very little bit of independent thinking going on. There are not a lot of people thinking for themselves on Wall Street. So by their nature, they don't have those characteristics. And sitting on Wall Street doesn't lend itself to have those characteristics. Once again, patience, discipline, eager to learn, harness your emotions, and think for yourself. By contrast, you look at Warren Buffett. He spent his entire career in Omaha, Nebraska. And I've spent time in Omaha, Nebraska, and it's ugly in the winter, and it's not very pretty in the summer. But it's a place where you could hole up and be patient and disciplined, eager to learn, harness your emotions, and think for yourself. And you could just shut out the outside noise, right? And that's good breeding ground for a wannabe intelligent investor. And I try to put myself in that situation to not listen to the crowd and to be patient and disciplined and eager to learn and harness my emotions and think for myself, right? So you don't want to be on the bandwagon, especially you don't want to be on the tail end of the bandwagon for investing. That's when the party's in full swing and it's already gone up. That's the time when you should start getting nervous, like, wow. Like, for example, I had a client tell me, hey, my son told me about this one company. What do you think? Well, the word's already got, and his son was not a professional in the industry. His son was just a kid. And so if word about this company reached that kid's, social network, if you will, there's a good chance that that news has already made itself through every place else first. You know what I mean? And I'll give you two examples in my career when I saw this firsthand. One was in February of 2000. For context, that was right before the dot-com bubble burst. And I was sitting in a Wells Fargo branch. I worked for Wells Fargo as an advisor at the time. And they brought over this guy to me. He was 63 years old, a Baptist pastor. And he had an IRA with about $165,000 in it. And he was managing it himself. And he had it in two mutual funds. One, and they were both tech funds. Two tech funds, and not like an aggressive tech fund, right? He had two aggressive tech funds. That year, in 1999, one of his funds was up over 70%, and the other one was up over 50%. So what he did was he took the money out of the one that was up 50, the laggard, if you will, right? And moved it into the one that was up 75. And I tried to talk some sense into him about, diversification, about this market's hot, it's overvalued, and you're 63 years old, you're a couple years away from retirement. Don't you think you should maybe tone it down a notch? And he's like, and he sat there with this supreme confidence. He was leaning back in the chair, his legs folded, and was not really wanting to hear a word I said. And it was, and he had gotten a paper cut, I don't know, making a deposit, and he was sucking on, his finger was bleeding, he was sucking on the blood, and he was just so supremely confident that he was doing the right thing. And I could not tell him otherwise. And this is what he said. He goes, "What's the worst that could happen? That it's only up 20?" Those were his words. That was how he had imagined the worst case scenario. That fund was down over 80% that year. Okay, so his IRA that went from 100 to 165, and that probably went back down to about 20,000. And my point is that this guy was the last guy in America to buy a tech fund. You know what I mean? Everybody else had already done it before him. There was nobody in line behind him. When he got to the line to buy this tech fund, there was a long line, right? And it was rowdy, and people were all excited about the money they were making. And he got in that line behind everyone else, I'm speaking metaphorically, obviously, not knowing that there was no one else behind him to take it up to that next level, right? Sure enough, it ended badly for him. So that's my point. When all the analysts are on board with a company, how much higher can it go? There's much more. It's probably overvalued, and there's more downside risk than upside potential at that point. On the contrary, I mean, when I showed up to buy Tesla stock, there was nobody in line. There was even nobody at the window to take my order. You know what I mean? I was the only guy there. Like, somebody at least joined me in this trade. That's what it feels like to buy a great opportunity when it's cheap. And if you look around the landscape, you take a step back, what does it look like today? Is there a long line of people wanting to buy stocks? There's lines starting to form, but I mean, as early as a couple months ago, there was nobody in line, right? And it would take a lot of courage to get in that line. And the analysts definitely were not in that line, because they're not going to be in the line by themselves. So, yeah, a bunch of analysts on board with the company is not, in my opinion, not a great sign. Not a great sign that I want to get in line behind them. I'd rather be in front of them. Okay, I'll give you another example. This happened in 2005, end of 2005, when, if you recall, in the 2000s, we had the dot-com bubble burst, and then real estate took off. like crazy, right? And I was looking at Fortune magazine, and there was this article, was a picture of a scantily clad Las Vegas showgirl, which is not something you usually see in Fortune magazine, so it caught my attention. And the article was about these Las Vegas showgirls in their dressing room between sets were buying real estate. I mean, multiple properties, right? They were on the phone with their agents, their real estate agents, buying multiple properties. And I had the same feeling that I had in my gut when I met with that Baptist preacher. And the end is near, because who's in line behind these girls to buy after them, right? They're probably at the tail. I'm not trying to be derogatory towards Vegas showgirls or Baptist preachers, but they tend to not be at the vanguard of financial innovations or what's going on in the financial industry, right? When word gets to them, it's already gotten to everybody else, you know? And so I just want to share this as a framework for thinking about investing. It's a lonely road, and my best investments have been done alone, you know, or not with the crowd, not as part of the crowd. And I could even say, use that argument against myself, because last year was not a great year in the portfolio, and we held on to some great companies that were Wall Street darlings that we probably shouldn't have held on for so long. You know, companies that analysts love. Like, by this time, analysts did love Tesla after it had run up, right? They loved Amazon and Google and the FANGs, right? They were Wall Street darlings, and those are the ones that pulled our portfolio down, right? You know, maybe if I would have been more contrarian, I would say, well, now that everybody loves them, maybe it's time for me to look for something else, right? And so I hope that gives you some perspective on what it's like on Wall Street, and the analysts and their nature is not to uncover gems. Really, they parrot what the group is saying, and that's how they have job stability. They keep their job by not rocking the boat, and their compensation is kind of geared that way. To if they're usually measured against an index, and they don't want to deviate too far from that index. That's how they keep. That's the safest way to keep their job. An analyst that makes big bets, he probably won't be around that long, because inevitably one of those bets is going to fail, and it's not going to look well. So that just gives you some perspective on what we think about analyst expectations. You know, we don't read a lot of that. There's a few that we like that are thought leaders and that are outside thinkers, but there's not many. That's not the nature of an analyst in general. Okay, so just something to think about. What works, and Benjamin Graham had this type of company that he liked. He called it the large company currently out of favor, right? Because it's a good company, it has, you know, strong financials. It just, for whatever reason, it's currently out of favor, meaning out of favor with the analysts on Wall Street, and meaning it's gotten beat up and its prices probably come down. So it's at a point where there's a good chance that it's cheap. I'll give you one example. Was a company that had the oil spill in the Gulf, British Petroleum, right? It had that oil spill in the Gulf. It went from 60 to 30, and I looked at it at $30, and I'm like, come on. I mean, that obviously that was a tragedy what happened in the Gulf, and they're going to have to write a huge check to make amends there. But here's a company that had $250 billion in revenue that year, and headlines where they're going to have to write a $25 billion check. I mean, nobody likes writing a $25 billion check, but it's something that's not going to sink this company. And Wall Street just turned sour against it and really beat it up beyond what they needed to beat it up, right? So at $30, it looked pretty good, and we bought it, and within a few months, it was back up over 40. When sane heads prevailed, right? Because Wall Street, what do they don't do? What do they not do? Harness their emotions and think for themselves, right? They're not patient or disciplined or eager to learn, eager to open up the financials and realize, hey, $25 billion is a lot of money, but not to BP. So yeah, we don't tend to follow analysts. Hope that gives you some insight into how we try to manage money, and we believe that lowers the risk. You know, when we buy something that's already run up, it has a lot of potential energy. And something I learned in physics, like if there's a book on the top of the shelf, it's sitting there with a lot of potential energy, meaning it could fall to the ground, right? Like a stock that every analyst likes. There's a lot of potential for one analyst to change his mind and then more and more to follow, right? But a book that's on the floor, it doesn't have a lot of potential energy because it's already on the floor. Where's it going to fall, right? It has the opportunity to go up. And so there's a lot less risk of that book on the floor falling than the one on the teetering on the edge of the top shelf. So probably went longer than I needed to, but hope that answers questions about, you know, why don't we pay more attention to what analysts on Wall Street are saying. Okay, have a great day.